Hi, welcome to Numeric's video blog. I'm Jim Jocko, your host. October 12th, circle the calendars. Banks have to start counting swaps transactions to see whether they're going to register in December as swaps dealers. Now, with me today, 20-year FX vet and vice president of Numeric's Client Solutions Group, Udi Sella. Welcome.
Thank you, Jim.
So, April 2011, U.S. Treasury comes out with a proposal to exempt Forex swaps, yet we are pressing on the October 12th date. Give us a little background of what's going on and why specifically FX swaps were proposed for exemption.
Sure. So we know, of course, that post the subprime crisis, the main issue is how to regulate the derivatives market in a way that incidents like the Lehman Brothers case will not reappear. Specifically, looking at the FX market, one of the most frequently traded instrument is FX swaps, which is these swaps are mostly used for funding reasons. The big question is if banks are required to report the FX swaps positions if they have more than $8 billion of nominal amount, and probably would be liable to capital charges. This may have an impact on the trading of FX swaps and the cost for the end clients. Important to mention, and I guess this is the main reason for exempting the swaps, is that FX swaps are used mostly for funding and not to execute a view on the market. When I say funding, it could be funding of an open position or just funding the balances of banks in the banks. So just to be clear, if I'm an American bank and I have balances in euros or Brazilian real and so forth, typically I would use FX swaps in order to cover my balances. And when I use FX swaps, I'm not changing the currency position of the bank. So one may ask, why should I be liable to additional capital charges when I cover my balances? I'm performing a funding operation.
So we hit the date. It's now October 13th. We're running towards December. What's going on in the bank if the exemption is not passed by that point?
So that would imply that banks will start registering the swaps, and assuming those large market makers would have additional costs. First of all, capital costs as well as operational costs. Banks, we know, do not operate in a vacuum, so they would like to charge this. They would charge the banks for this additional cost. So that would imply that corporations, investment firms, etc., would have to pay a higher price for funding operations.
So the cost gets passed through. What about the market implications itself? You had a webinar a few weeks ago proposing several strategies given the low vol environment of many pairs in market right now. What, if any, market moves would happen based on the lack of the exemption going forward?
I would think that if the regulation goes through, that we will see less operations in the market because people would be reluctant to execute trades because they would understand that the trade actually has an additional cost now, which is the funding cost. So why should I enter into a position or even an investment decision if I know that I have to make more in order to cover my funding costs, the additional funding costs? So I would suspect that volatility would decrease further.
So one last question in this particular video blog for the day, and looking at a Reuters article earlier this week covering the issue. One of the things that has been tied to this is, as quote-unquote political risk around this, has been LIBOR and its consequences. And one of the things that struck me, quoted in the article, was, quote, "The LIBOR scandal, which is a key input into FX swap valuation, was shown to be fraudulent and manipulated by participating banks and shows exactly how problematic it is." Give us the role of LIBOR in valuation for FX swaps.
So I have to admit I was very surprised when I saw that too, because Personally, I don't see what is the difference, what is the relationship between, or what is the connection between LIBOR and FX swaps. I've traded FX for many years, and we never priced FX swaps off LIBOR rates. LIBOR represents the offering rates, 11 London, and it has nothing to do with pricing of FX swaps all along the day. So that was kind of surprising, and I think there's no need, there's enough to be said about LIBOR and regulating and governing in a way that people do not misconduct. But it has nothing to do with FX swaps.
So maybe I put you on the hot seat and we'll go through another case study around proper valuation and the roles for FX swaps going forward. So thank you, Udi. I appreciate your time today. That'll conclude today's video blog. Feedback, let us know. The questions you want to hear answered, we'll definitely address them. And please follow us at NXAnalytics at twitter.com and on our blog at numeric.com. We'll see you soon.
Thank you.